have you on the show. Just taking a leaf from what Harsh was just highlighting, I want to understand what is it that you're looking at in terms of growth numbers for Q1 and, of course, the entire fiscal as well. And how do you see inflation now impacting these numbers?
Yeah, hi. I would say we are slightly below consensus forecast and also below what the RBI is suggesting, but nevertheless a strong number. So on a year-over-year basis, we're expecting around 13.5% on real GDP growth. This is partly base, but sequentially the momentum should also be very strong. So on a seasonally adjusted basis, the quarter-on-quarter number should be about 2.7%. That's higher than the March quarter, which implies that on an annualized basis, GDP rose by close to 11% in this particular quarter. So a fairly solid reading. And I think as your polls were suggesting, a lot of this is reflecting the impact of reopening on services and overall on domestic demand. Now, in terms of the outlook going forward, the momentum in the second half of FY23 and into FY24, we do think will be on the softer side because of the global headwinds. Nevertheless, for FY23, the average real GDP growth we're expecting is around 7% or so. In terms of the impact of inflation on these growth numbers, I mean, inflation typically tends to be a negative for growth. But I think the pinch in particular is being seen in segments where real disposable incomes are under stress and savings buffer is less. So essentially, the rural side, I think, is where the more adverse impact of inflation is currently seen. For most other segments, as of now, we haven't seen a material negative impact of inflation.
Sonal, RBI in its estimate has pegged oil at $105 to a barrel. Wanted to understand what estimates are you penciling in and how much of an impact do you think it's going to have then on demand? And, because thereby it has a domino effect of sorts on global inflation as well.
So our estimates on oil, I would say, are close to what the RBI is estimating. And to be fair, there are lots of positives and negative drivers of oil at this stage. So there is high uncertainty on how things will play out. At these assumptions on oil, i.e. between $100 and $105 per barrel, I think India's growth this year of 7% is fairly reasonable, even with that kind of oil prices. What is more important is what is the global growth backdrop at these oil prices. So there is a clear sign that we are headed into a synchronized global growth slowdown. In fact, our own house view is there'll be recessions across US, UK, Euro area, and a number of other countries. So if high oil comes alongside lower global demand, then it becomes a bigger stagflationary shock for oil importers like India, because then the hands of policymakers really gets tied because you have negative growth impulses, but inflation still quite sticky. So I think the growth backdrop actually matters also a lot more. And there is, I would say, still a lot of uncertainty in terms of the direction of oil prices.
Okay, so we've got our eyes firmly on crude oil. It's always a hurrah moment, right, when we see crude oil going down. But Sonal, the other thing to talk about is, of course, the currency. Today, when you and I are chatting, yes, the US dollar index is off the 20-year high. But just the way the rupee has been behaving, it has been slipping. We've seen regular interventions by the RBI, indications there from the lowering of the forex reserves as well. How big a risk is this for the Indian economy for the rest of this fiscal?
Well, we don't see this as a risk to the Indian economy per se, because I think on most external parameters, we still have enough buffer, including on the FX reserves, where RBI has drawn down and will likely continue to draw down. Now, in terms of just the flow of the external sector, things are, however, on the negative side. So the current account deficit for FY23 is tracking around 3.5% of GDP, so close to 110 billion US dollar. And the US Fed is basically going to be tightening into, what we think will be a recession in the US. So that global backdrop does cause typically more capital outflows from emerging markets. And therefore, from a balance of payment perspective, we do think the pressure will remain in terms of currency weakness for the foreseeable future. So our view is RBI will continue to intervene. It's not a major problem. Most EM currencies are depreciating. And we have INR depreciating to about 82 to 83 versus the dollar by the end of this calendar year.
You're not expecting that to be a big challenge, the dollar index and the movements that it is. Sonal, can I ask you, how many more rate hikes and what kind of quantum are you folks factoring in when it comes to, India? We are now in the era of what is being called quantitative tightening. We're getting cues from the US Fed, from back home, from the RBI. What's your expectation?
So on RBI, I think going forward, our view is the focus still remains very much on continuing to raise the policy rates, because on our forecast, headline inflation CPI will remain above 6% for I would say entire FY23, despite the moderation we've seen in global commodity prices in the last few months. So that still calls for more rate hikes. But in terms of the pace of rate hikes compared to the 50 basis point we've seen so far, looking forward, our view is the pace should come down. We are expecting a 6% terminal on the repo rate, with a 35 basis point in September and then a 25 basis point in December. Beyond that, the two things will become important. One is how significant are the global growth headwinds, and to what extent they bring down commodity price inflation in this cycle. And two is the speed with which RBI wants to get to the 4% target. I mean, they've indicated 2 years time frame to get to 4%. Typically, that would require the repo rates to stay elevated. So I think there's a bit more uncertainty in terms of the path beyond 6%, but still expecting more normalization ahead.
Sonal, great to have you on the show. Thanks as always for joining in. We'll chat again also perhaps after the GDP numbers come out.